Managing risk and optimizing trading strategies are crucial components of successful options trading. While margin requirements can seem daunting, understanding them is key to efficient capital allocation and effective risk management. Today, we will demystify margin requirements at BMO InvestorLine, offering clear examples to illustrate how you can leverage different option strategies with confidence. Let's dive into this essential topic to enhance your trading knowledge. Options are powerful tools that offer the flexibility to speculate, hedge, and generate income, depending on your trading goals. They give the buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price within a certain time frame, while the seller assumes the obligation to fulfill the transaction if the buyer chooses to exercise the option. Margin requirements in options trading are like a safety deposit you need to make when you engage in certain types of option strategies. When you want to trade options, some strategies involve higher risks and potential losses, and your broker requires you to put down a certain amount of money as a guarantee to cover any potential losses. This guaranteed money is called the margin. Think of it as a financial cushion that helps protect both you and the broker. If the value of your options trade moves against you, this margin acts as a buffer to cover potential losses. Essentially, margin requirements help manage risk in options trading, ensuring there is enough collateral to back up your positions. Some option strategies require margin, while others do not. For instance, buying options, calls or puts, doesn't require margin because you're only risking the amount you paid for the option. However, strategies like selling uncovered calls or puts or engaging in spreads often require margin. These strategies involve higher risks, as you could face significant losses if the market moves against your position. Covered calls can be traded in both registered and margin accounts. In registered accounts, there's no margin requirement to trade this strategy, while there will be a margin requirement if you trade covered calls in margin accounts. There are 3 levels of options trading at BMO InvestorLine. Let's explore these levels, each permitting different strategies and associated with specific margin requirements. Options Level 1 includes more straightforward strategies, such as long calls, long puts, and covered calls. Here, the margin required is 100% of the total net cost of the trade. For long positions in calls and puts, you pay the full premium up front, which is the total risk of your position. For example, buying a call option on XYZ stock with a $210 strike price for $10 premium, or $1,000 per contract, gives you the right to buy the stock at $210 per share on or before the option's expiry date, regardless of the market price. The $10 premium is your total investment in risk, which you would lose if the option expired worthless. This would happen if XYZ remains below $210. The margin requirement for this long call is limited to the cost of the premium, with no additional margin needed unless you exercise the option. This makes long calls a common choice for leveraging positions with defined risk, capping your financial commitment and margin on the trade to the $1,000 paid for the option contract. Long put contracts have similar margin requirements, limited to the premium paid. In our discussion of Options Level 1, we also encounter covered calls, a strategy often used for generating extra income on stocks that are already owned. Let's unpack this with an example. Imagine you own 100 shares of XYZ, currently trading at $221 per share, which you purchased for $180 per share. You decide to write a covered call by selling one call option with a $215 strike price for a premium of $7 per share. While the short call option itself carries unlimited risk potential, since you would need to provide the shares at $215, regardless of how high XYZ's stock price might go, this risk is effectively managed because you own the stock. The margin requirement on this strategy depends on if the covered call written against the underlying is out of the money or in the money. If you sell an out-of-the-money call, the margin required is the same as the margin required on the underlying security. There's no additional margin for the calls component of the strategy. If you sell an in-the-money call, The stock's lending value is limited to the strike price of the option, not the full market value of the shares, which means even if the stock trades higher, lending value will not change. Being aware of this can help you manage your margin and avoid unexpected funding constraints. Using our example of a current XYZ price of $221, the margin requirement would be the market price minus the lending rate times the strike price times the number of contracts times 100, which totals $7,050. Moving to options level 3, we encounter more advanced strategies like spreads. Let's look at an example with XYZ stock and go over debit and credit spreads. Suppose we buy 5 call options on XYZ with a $220 strike price expiring in 30 days for $5 per share each, and simultaneously sell 5 call options with a $225 strike price expiring the same day for $2.50 each. The net cost of this spread is $2.50 per share, or $250 per contract, representing your total risk and margin requirement. The margin requirements for debit spreads are straightforward. They're calculated as 100% of the net debit, which is the difference between the purchase price of the option and the selling price of the option. In this example, the purchase price of the $220 call is $5. The selling price of the $225 call is $2.50. The net debit would be calculated as $5 minus $2.50, which equals $2.50. Given we're trading 5 contracts, each representing 100 shares, the total margin requirement would be $2.50 times 5 times 100, which equals $1,250. This $1,250 represents your total risk and the required margin for this debit spread. Now let's discuss credit spreads, another advanced option strategy that requires options level 3. A credit spread is a trading strategy that involves selling a higher premium option and buying a lower premium option on the same underlying security. Let's dive into an example with XYZ. Let's say the current stock price of XYZ is $221. We sell 5 call options on XYZ with a $225 strike price, expiring on July 19th for $2.50 each, and simultaneously buy 5 call options with a $230 strike price, expiring on the same day for $1 each. Here, you receive a net credit of $1.50 per share, or $150 per contract. The margin requirement for credit spreads is calculated using the lesser of 2 methods: the difference in strike prices minus the net credit times the number of contracts times 100, or the uncovered margin requirement on the short side of the spread, which is the greater of 30% times the underlying price plus the short premium per contract minus the out-of-money amount per contract times the number of contracts times 100, or 5% of the underlying price plus the premium times the number of contracts times 100. Let's break down each method using our example. The difference in strike price is $5 minus the net premium, which is $1.50 times 5 contracts times 100 shares, which equals $1,750. Or the uncovered margin requirement on the short side of the spread: A, 30% times the underlying price of $221 plus the short premium of $2.50 minus the out-of-the-money amount per contract of $4 times 5 contracts times 100 shares, which equals $32,400. Compared to B, 5% times the underlying of $221 plus the premium of $2.50 times 5 contracts times 100 shares, which equals $6,775. And the margin requirement for the total position would be the lesser of $1,750 or $32,400, which would be $1,750. Margin requirements for spreads vary based on the spread type. For debit spreads, the maximum loss is the amount paid for the spread, whereas credit spreads require margin for the maximum potential loss minus the credit received. Finally, let's now move to Options Level 5, which allows for the most advanced option strategies, including uncovered options. Let's dive into uncovered calls and puts, which is a more advanced strategy allowed under Options Level 5. This strategy carries significant risk and, therefore, higher margin requirements. The margin needed is based on the potential risk of the option becoming in the money, which can be substantial. Additionally, margin requirements can change at any time, including additional requirements at BMO's discretion. The margin requirement for selling uncovered calls and puts is calculated using the greater of two methods: 30% of the underlying price plus the premium per contract minus the out-of-money amount per contract times the number of contracts times 100. Or 5% of the underlying price plus the premium times the number of contracts times 100. Furthermore, under the 4 times equity rule, the margin requirement for your total uncovered position multiplied by 4 must not exceed the total net equity of your account. The total uncovered margin required includes the current uncovered order, any open uncovered orders, and any existing uncovered positions. Let's illustrate this with an example. Imagine you're selling 10 uncovered put options on XYZ with a $220 strike price for $6 each. Here are the margin calculations. 30% of the underlying price of $221 plus the premium of $6 minus the out-of-money amount, which is $1 times 10 contracts times 100 shares, which equals $71,300. Or 5% of the underlying price of $221 plus the premium, which is $6 times 10 contracts times 100 shares, which equals $17,500. In this case, the margin requirement is the greater of these two amounts, which would be $71,300. Moreover, using the 4 times equity rule, the uncovered portion of the $71,300 times 4 equals $285,200. Thus, you must have over $285,200 in net equity to open this position, assuming you have no other uncovered positions or open uncovered orders. To sum up, there are 3 levels of options trading at BMO InvestorLine. Level 1 is for strategies where the total risk is limited to the premiums paid for the strategy. Level 3 is for strategies where there is defined risk or potential loss, but the risk could be different from the premium paid or collected. And lastly, Level 5, where the risk could be unlimited or substantial. To better understand how margin is calculated for each of these levels, here's a summary that shows a breakdown of the 3 options trading levels and their respective margin requirements. Understanding and managing margin requirements is essential for options trading at BMO. Each level increases the complexity and potential reward, but also the risk and margin needed. Always assess your financial situation and risk tolerance before diving into options trading. Visit bmo.com/online investing to get started.